it's time for talking about, well, when the markets hit fresh highs, Alex, everybody used to say that, oh, the one pocket to avoid is PSUs. Suddenly we see when the markets now hit fresh highs, everybody talks about one pocket, and that is PSUs.
You cannot ignore them, love them or hate them. In 2024, PSUs are the ones to talk about. And I'm sure that people that have been looking at the markets for the last few years will remember times when PSUs were trading at 1 time or less price to book. That is no longer the case.
When was that?
Some people might find it hard to remember those days because, and if you thought that you could buy a PSU on a song, you might actually have to change your tune very quickly. So, but let's talk about what is on offer right now and whether the valuations support the fundamentals. That's all lined up today. Harsh, Agam and Neeraj all have information to take through for you so that you can make your decisions with a little bit more information. So let's start with a wrap of how things have been, right? In that, what a performance it's been over the last 15 months, Neeraj.
Yeah, so at 15 to 18 months, if you take an idea, the BSE PSU index, I'm using that as an example, the market cap is up over 2x. 2x in 18 months for PSUs is not something that was commonplace maybe a few years ago, right? So that's one thing. The P multiples, and Harsh will probably talk about price to book, but non-financials, you look at PE, the PE multiples, 12.8 times or 13 times versus 8.5 or 9 times. This is as per a Motilal Oswal note. So the multiples have moved up quite substantially as well, right? Nearly 40% uptick in multiples itself. 2 times 12-month forward price to book, if I'm not wrong, Harsh, or an average, maybe a decimal point here and there, but 2 times price to book now, so to say. And ROEs are at decadal highs. So there is a fundamental reason why some of the PSUs have done what they have done. It's not just a market cap gain. There is also fundamental changes in that ROEs have moved up. And, you know, I mean, if you just look at everything else notwithstanding, this whole emphasis on localization, make in India, give preference to PSUs, defense, etc., maybe the center point, but everything else out there, so kind of brings them. But the thing is, and, you know, I'll talk about the non-BFSI pocket, and just this, compare the increase in profitability, just taken one simple metric, versus the increase in market cap over the last 12 months. So viewers, FY23, end of FY23, the PAT versus the recent PAT numbers that have came out, so 12 months, and the increase in market cap. So look at this. HAL, 30% increase in PAT, 293% increase in market cap as of yesterday. Give or take a few points, right? Depending on close. BDL, 74% increase in PAT, 217% increase in market cap. Coal India too, we call it a slow mover, 32% increase in PAT, but 118% increase in market cap. Cochin Shipyard, I mean, this is stuff that dreams are made of, right? 156% uptick in PAT, yes, but 820% increase in market cap. Even EIL, 28% increase in PAT, 242% increase in market cap. And the multiples, guys, I mean, look at that. FY23 PE, the stocks were trading at 15, 51, 4.5, 20 times PE. And look at the trailing 12 months PE for some of these stocks. I mean, this is crazy stuff. They are certainly climbed the part of the valuation. So that is the point. That's the first point, right? On at least the non-banking ones. Maybe Harsh has data on banking that we should try and talk to. But Alex, the limited point is that yes, there is an increase in fundamental performance, but the valuation re-rating has been very substantial.
So we will, let's run through actually the PSU banking pack as well, because that will tell a similar story. And then we'll jump into what the fundamentals stand at right now and the outlook going forward and whether or not the valuations support that. But the PSU banking pack?
Well, yes. So I've tried to cover 4 key banks and 2 NBFCs. So let me start off with SBI, the big boy of the pack. 66% growth in terms of stock price, valuation, market cap, and every day breaching new highs, SBI. And your PAT growth has been 22%. But is that the right way to look at it? Maybe not, because fundamentals have changed quite dramatically. SBI, which was expected to grow, or most PSUs which are expected to grow mid-teens, are yes, or maybe in just about double-digit kind of loan growth, are now clocking mid-teens kind of loan growth, and therefore the market is starting to reprice some of these, and the confidence comes from the fact that asset quality is clean, right? And justifiably so. Also, recoveries are very strong. So some of these factors are behaving as a tailwind. So you'll see some of the, some of the growth numbers in terms of profit after tax, but may not be the best metric. But you look at the last 15-month returns, clearly signifies that there's plenty of tailwind that the industry is currently seeing, and asset quality is holding up fairly well. So there's no concern there. When you're looking at valuations, if I can switch that picture, 15 months back, valuations were roughly between the 0.5 to 1 time price to book outside of SBI, right? SBI was at 1.3. All of them have re-rated dramatically. So they've literally doubled in price to book valuations at the very least. Yeah. PFC has gone up 3.5x. REC has gone up 4x just in terms of price to book valuations, from half to 2 times. So some of these themes are really now looking at multi-decadal themes in terms of growth, especially for these energy financiers. And you're looking at some of these public sector banks being able to compete more effectively with private sector banks because asset quality has come in very, very well.
Just one question, if I can just bring in Alex with your permission. Sage One did this analysis of the recent past, and they have looked at what's happened to PSU financials and energy stocks, or so PFC, REC, etc. And there they're saying that the P multiples haven't they've used P, but not dramatically moved up because profitability growth for a PFC, REC and some of the others has also been very strong.
You're so absolutely right, but Neeraj, key to watch out here is the reversal in terms of provisioning, ECL basically. Right. Credit loss reversals have been very strong, especially for these power financiers. So I'm not really sure whether that is the correct base to take, because that may be a 1 or a 2 year theme, right? The reversals may start to go back to provisioning, in which case your profitability will start to either flatten or fall.
So take that with a pinch of salt is the bottom line.
Yeah.
There is one more update before we move into the operational picture and how things look going forward. And there is a significant update for Mazagon shipbuilders. We spoke about Cochin Shipyard. Similar business for Mazagon, right?
Yeah.
So, but they've become Navratna today. How significant is that?
Well, it certainly is a feather on the cap for Mazagon Dock, because we know about the kind of traction that they've seen over the past years in terms of the kind of order flows. Well, at the moment, the fact that it gets a Navratna status, what it means for Mazagon Dock is that, firstly, that it can invest in projects up to 1,000 crores without the government's approval. Moreover, it can also use up as much as nearly 30% of its net worth for several projects, once again up to 1,000 crores, once again without a government's approval. But more importantly, I reckon that when it comes to lending, a lot of banks would now be a little bit more open to lend to Mazagon Dock because of the Navratna status. So the Navratna status does open up a lot of doors, but naturally this does mean that it's a big positive for sentiment. Of course, it has a very large order book, a substantial amount of visibility. So the 1,000 crores is not going to matter as much. But well, it's a positive in terms of sentiment all the same.
And look, it's not, I didn't see it on the list of stocks that you put up, but then it's not anything to scoff at either. 73% in the year to date so far is the stock price increase, 216%
so
in the year.
There is a pack of defense companies which have actually done very, very well. And the only limited point that I wanted to add was the fact that of course there's been a huge up move in their profitability, but they also have a substantially large order book, which actually gives them visibility of up to 4 to 5 years down the line. In fact, some of these orders are not even going to be delivered over the next 2 years. The delivery of these orders will start from 3 years onwards, and that's when they start getting those revenues and coming through.
So for the manufacturing companies then, and we'll come to the banks in just a bit, just to wrap this up, is that the most important fact? The fact that there are large orders that are currently available to them or in their books, and the prospect of significant more orders coming through, the defense minister talking about export orders for defense companies and various other manufacturing companies also looking at that. Do you look at PSU manufacturing companies from a different lens and say, 1.8 times or 2 times is now par for the course?
I think the market is already looking at them differently, and which is why the valuations that are ascribed to them. But yeah, I mean, Defense Minister saying, Zen Technology is saying that the next 5 years will dwarf what has happened in the previous 10 years. Just the question is at what valuations. And the one point on the non-financiers, and I rest my case there, is that brokerages are now coming out and saying that Baba, the stocks have run up a bit. So we are revising our list. So Motilal Oswal, for example, in the latest note has said that their ideas are now SBI, Coal India, BOB, GAIL, HPCL. They're saying we can't recommend, which are trading at good valuations, 7-8 times price earning multiple. I mean, Coal India and GAIL, etc. and stuff like that. So they are kind of shying away from making a fresh recommendation on some of the defense stocks. But the point is absolutely well taken. The street is looking at them differently because of the order visibility.
Very quickly on the banking pack.
So
same point.
Yeah, so of course it's a multi-year tailwind with regard to credit growth in general, not just with regard to corporate. At the moment, we've not seen corporate really pick up. So we'll have to see corporate capex really pick up to kind of get a feel, get a sense of whether there is that confidence to borrow. So I think it's too premature to kind of just conclude that corporate capex will pick up. But yes, the consensus view seems to be H2 or second half FY25 corporate capex is expected to pick up. That's
my biggest takeaway is that while everything has rallied and everyone has done well, don't have a pray and spray kind of approach from here on, be more selective. But it isn't over yet. The PSU story definitely isn't over. We certainly aren't calling it. So that's what you can take from that. There are still buyers, of course, in the stock, and that's evidenced by the kind of moves that you're seeing on a daily basis.